Hello everyone. Now let's finalize this chapter by going over some related topics to capital investment analyses. And one of those decisions that many businesses would go through is lease versus capital investment. So what's the difference? So leasing fixed asset is very common in many industries. Some advantage of leasing a fixed asset include things like the company has use of the fixed asset without spending large amount of cash to purchase the asset. So in other words, they don't tie the cash by buying it, and instead they're just renting it or leasing it from other companies. So another thing would be the company eliminates the risk of owning an obsolete asset. Things can get old, and when you are leasing the asset, you don't own it. So you don't really worry too much about how I'm going to get rid of this old asset. Another advantage is that the company may deduct the annual lease payments for income tax purposes. So what is the major disadvantage of leasing a fixed asset is that it's normally more costly than purchasing the asset. So, which is because the lessor or the owner of the asset includes in the rental price not only the cost of owning the asset but also a profit, which is totally normal. Now let's talk about uncertainty and changes in price levels. All capital investment analyses rely on factors that are uncertain, which is especially true for long-term capital investments. And errors in one or more of the estimates could lead to incorrect decisions. So things like changes in expected return, changes in cash flows, all of these things can change how we do the analysis. General price levels often increase in a rapidly growing economy, which is what we all know as inflation. So during periods of inflation, the rate of return on an investment should exceed the rising price level. Otherwise, the cash return on the investment will be less than expected. Another thing that investors should pay attention to is currency exchange rates. And how would that affect the investment decision? So let's try to remember, what is a currency exchange rate? These are the rates at which currency in another country can be exchanged for US dollars. So when a company has an investment in another country where the local currency is weakening, the return on investment as expressed in US dollars is adversely or negatively impacted. So that's why you don't want to invest in a company where their local currency is going down day after day, because that would really have or would have a negative impact on your investment. Now let's talk about other qualitative considerations that investors should keep in mind whenever they're making any kind of investment decision or investment analysis. Of course, we do all these kind of analyses based on some kind of quantitative calculations. But there's also qualitative considerations that we should keep in mind. So some benefits of capital investments are qualitative in nature and cannot be estimated in dollar terms. Some examples of qualitative considerations that may influence capital investment analyses include the investment proposal's impact on the following elements, like the product quality, manufacturing flexibility, because when you are, like let's say you're investing in a machine, even though it might not be the best investment, but because it provides you with this kind of flexibility, that adds value. It can also have an impact on employee morale. It could also have an impact on manufacturing productivity and market or strategic opportunities. So many qualitative factors may be as important as, if not more important than, quantitative factors. So that would take us to something called capital rationing, or the rational decision of how we make an investment decision. So capital rationing is the process by which management allocate funds among competing capital investment proposals. Alternative proposals are initially screened by establishing minimum standards using the cash payback and the average rate of return methods. Because these are the simple methods, so we want to see like whether is it really feasible or not. Then the proposals that survive the screening are further analyzed using the net present value and internal rate of return methods. And remember, these two methods are more complicated, but they provide you with much better kind of quantitative decision compared to the cash payback and the average rate of return. Qualitative factors related to each proposal should also be considered throughout the capital rationing process. And then accepted proposals are ranked and compared with the funds available. Finally, proposals that are selected for funding are included in the capital expenditures budget. And here we just have like some kind of presentation of the process. Again, it just repeats what we went over right now. So now let's go over a quick knowledge check. In capital rationing decisions, which of the following methods would be used first in the screening process? Is it ranking of proposals? Is it the net present value? Is it the internal rate of return? Or is it the cash payback? Again, the first screening process starts with the simplest methods. And in this case, the cash payback would be the simplest methods. And then we go over the net present value and internal rate of return. And then finally, we can go through ranking of proposals. So the correct answer in this case is choice D. So alternative proposals are initially screened by establishing minimum standards using the cash payback and the average rate of return methods. The proposals that survive this screening are further analyzed using the net present value and internal rate of return methods. Right, so the last thing in this chapter is to go over some analysis for decision making, and we'll talk about uncertainty, so things like sensitivity and expected value analysis. So starting with sensitivity analysis, it considers the impact of changing one or more input or assumptions on the resulting answer, or in other words, the output of an analysis. So in capital investment analysis, the inputs are normally estimated revenues, expenses, the cash flows, the useful life, the desired rate of return, and also residual value of investment. So let's see an example to see how sensitivity analysis can be applied. So assume Bryant Incorporated is considering an investment in equipment. The cost of the equipment is $2.5 million. The residual value after 8 years is going to be $100,000. The annual net cash flow is about $600,000, and the desired rate of return is 15%. So if we do the net present value of the equipment, we will find that the present value of the annual net cash flow based on 8 years at interest rate of 15%, the factor would be 4.487. So we take 600,000 multiplied by 4.487, and that would be 2.692 million, or $200. And again, this factor here is the present value factor of an annuity of $1 at 15% for 8 years. The present value of the residual value, which is the $100,000, in this case we need to use the present value of $1, not annuity. So we got the factors 0.327, same thing for 8 years, 15%, multiplied by 100,000, and that's 32,700. So the total present value of this equipment is $2,724,900. The amount to be invested is $2.5 million. Subtract the investment from the total present value to get the net present value, and that's the $224,900. So in this case, since this is a positive value, this indicates that this is a profitable kind of investment in equipment. So the positive net present value of the $224,900 indicates that the investment in the equipment is justified. Assume, however, that there is uncertainty concerning the estimated annual net cash flow, which could be as low as $400,000 per year. So here we're under the assumption that annual net cash flow or cash inflow would be $600,000, but it can go down to $400,000. So in this case, we try to do some sensitivity analysis. So management requests a sensitivity analysis assuming annual net cash flow of 3 options or 3 scenarios: 400,000, 500,000, and 600,000. And we do the same analysis. The only difference, as you can see, that the total present value because of the present value of the annual net cash flows, one time we have the same factor, but one time multiplied by 400,000, the second time 500, and the last time 600, which we already calculated. So that would have an impact on the, the, the values for the present value of the annual net cash flows. Of course, the residual value is the same. The total present value would decline the lower the estimated annual net cash flow. In the scenario of 400,000, 500,000, you can see that the net present value turned out to be negative. Of course, that makes us a little bit scary because now if you don't create a cash flow that's equal to 600,000, then in this case you go below that 500 or 400, the net present value turns out to be zero. The next question is, what is the exact value or the break-even point that would make our net present value zero? In other words, how much net cash flow should be generated in order to be generating a zero? So to do that, annual net cash flow greater than 549,877 will generate a positive net present value. So how did we do that? We created this formula where we have the annual net cash flow multiplied by the factor plus 300 plus 32,700, which is the present value of the residual value, minus the initial investment, which is 2.5 million, equals zero. So by solving for this formula, you get an annual net cash flow of 549,877. So that's your break-even point. If the equipment is generating less than $549,000, then in this case you will end up having a negative net present value, which does not justify the purchase of this equipment. Now let's talk about expected value analysis. So expected value analysis assigns likelihood or probabilities to various inputs, thus incorporating uncertainty directly into the output or the answer. So in the previous example, Bryant assigned the following likelihood to the possible annual cash flows. So 600,000, 500,000, and 400,000 had the probability of 0.7, 0.2, and 0.1. So you see here the highest probability is for the 600,000, but we still have like 0.2 and 0.1 for the other net cash flows. So what we are going to do is that we have to calculate the expected value of the annual net cash flow. And how we determine that? By multiplying each of the possible annual net cash flow by its probability of occurring. So simply we take each one of these values and multiply it by its related probabilities. And then we get the expected values for each one, and then add them together. That would be the expected value for that kind of equipment. And in this case, it turned out to be $560,000. So the expected value of the annual net cash flow of $560,000 is used to determine the expected net present value of the equipment the same way we've done it before. So we get the 560 multiplied by the factor, and then we also have the present value of the residual value. That would give us the total present value, subtract from it the amount of investment, which is 2.5 million, and that would end up giving us a positive net present value of $45,420. And again, just to let you know why this turned out to be positive, looking at the expected value 560, if I go back to a couple of slides when we're calculating the break-even point, the break-even point here was 549, and as you can see 560 is above the 549, and that's why we have a positive net present value. So the positive expected net present value of 45,420 justifies investing in this equipment. So because future events are being estimated, uncertainty cannot be totally eliminated. So by that I conclude chapter 26, and I conclude everything I want you to learn about managerial accounting. I wish you all the best. Please let me know if you have any questions, and good luck.